Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, October 17th, 2022. It is 10:09 Eastern Time as I'm starting the video. And what I'm going to do in this one is a quick overview of the stock market and the bond market, particularly treasuries, but time permitting, I'll take a look at, I'd like to show you some of the other bond markets, such as corporate investment grade, corporate below investment grade, i.e. junk bonds and municipals. All right, so this is the stock market. If you're going to use any one index, it's most accurate of the entire stock market would be the Wilshire 5000. It's got all small, mid, large caps, 5,000 companies. So you're not limited to just the 100 in the NASDAQ 100, which also has a very heavy weighting towards tech stocks, lax financials. So this one, even does a better job in the S&P 500, just again giving you an idea of the stock market. And I'm just starting out longest term time frame. You can't see at the top. I have it. Oh yeah, you can see it right here. Monthly chart. You can draw this trend line a couple different ways if you wanted to. You could probably come in and capture that low and then take that low as well, but those don't line up. So this is the line I have, and I've had on the Wilshire for quite some time, because you have these distinct reactions on it throughout the way. So 1, 2, 3, 4, even clusters 5 there, a little brief break below when COVID hit, but then we snap right back above it. That next green candle close above. And there we are now. So we're at support there. We are below the my big 20-month exponential moving average. It helps to delineate bull and bear markets, even if they're quick. And the big corrections, you can call this one a bear market if you want. By that metric, it was the drop that from high to low in the Wilshire was 37% almost. This one most certainly is, and you can see, so that trend indicator remains bearish. So right now, as I've been saying, the risks have shifted over the last week or so to more of bilateral, meaning I can make almost as good a case for a significant rally or a big drop. And I think this week will tell us. Let me just step it down here. We'll get to QQQ, and then I'll move on to the bonds. This is a weekly chart. All right, why are the risks bilateral for not just a little bounce, a big move? Well, these divergences are either going to play out or not. It's very rare, very, very rare to get positive divergences on the weekly time frame. Usually that comes at the end of bear markets, and they are worth noting. The indicators, market seems to hold up the last few weeks. You remember, these are momentum indicators. They're going to start turning up when you don't even have to go up from here. You just have to stop falling. That's how momentum works. If you are falling and all of a sudden your rate of descent slows, that will change the momentum indicator. So if you trade sideways for a while, this could turn up, and ultimately, of course, if you rally, you're going to get a bullish cross, and that will confirm the positive divergence. Likewise, I showed you back in the last bear market in 2008 when we had almost identical divergences at this almost identical point in that time of the bear markets, roughly the same drop, roughly the same time, that those divergences didn't play out. You had another leg down. So like I said, bilateral, it's going to go either way. If you think that's wishy-washy analysis, do with it what you want. It just tells me don't get, just don't be married to any one bias, because I do not believe anything's possible. I don't believe we're going to stay here and do this. I think it's going to be a pretty big up, because if we recover, if you look at it this way, the Wilshire, just like the S&P 500 and NASDAQ 100, it undercut support. This was a major reaction high here and here. It was the previous bear market low. You undercut it, and now you're back above it as of now. Yes, I'm on a weekly time frame, so we'll see how this weekly candle closes. But there's your divergence right there, positive divergence. Step it down to the daily time frame, same thing, positive divergence. Undercut the recent low, we're above it now. The day is not over, and most certainly the week isn't over either. So this chart can and will change. We're going to probably have a good idea, I suspect, by the end of this week if this thing's going to go and hold that low and play out for a rally. And as I said, if the rally does play out, if we can hold these lows and clearly put that previous low, make this a bear trap. So far, we back tested on QQQ. I'll get to that in a second. Got rejected last week. But if we can start to recover last week's highs, then that's going to be a big start right there. And then again, you have a trend line here, maybe a little reaction there, but if that pops, you can see, let me just measure it for you. So potentially, If we run up and back test these trend lines and the 200-day moving averages that are up around that level, you're talking, if and when we get there, about 12-13% rally. And also keep in mind, I believe if that happens, it's only going to be a bear market rally. I think there's more downside. There's your bear market downtrend line. Just a rally that you may not want to ride out short, and you may want to try to catch some or most of long if possible. All right, so that's that. You can go down to the 60-minute time frame. Same thing. So when I see divergences on my primary, these are my primary swing and trend trading time frames: 60-minute, daily, weekly. And like I said, we keep flirting with those previous lows. Let's go to QQQ, because to me that's the big index. There it is, that about 270-ish level. Here, we'll go to the daily chart. Well, before I leave the 60-minute chart, I gave you that one this morning. Let me just show you, these are the divergences that are still at this point in time intact on the 60-minute daily time frame. You can see the positive divergence still there. Looked like it was curling up. PPO started to go down, but it's still there. It's still unconfirmed. And when you zoom in really tight, you can see this was nice support back here all the way back in 2020. We had some consolidation, a correction there after the bottom was in and after COVID. And then that was our previous low right there. That was also T3 on my weekly chart to the button. So we expected a bounce, and we got the bounce. Then we undercut it. And you know what happened last week. We undercut it, had that big intraday reversal. Then we got rejected and didn't confirm the bear last week's bullish engulfing candles that were put in on Thursday, nor did we negate them. So that's where we stand. It's the same thing. We're either going to move up here. Now, if we can get above there and start printing some green candles, as I said, you don't have to have a green candle the next day. It certainly would have helped the case to see more green candles immediately, but as long as you don't take the bottom of the candle, it's still a bullish engulfing candlestick. Once you undercut the bottom of it, then it can't possibly be a bottoming stick, because if you go lower, then that's the bottom, right? Does that make sense? So a bullish engulfing candle is a potential bottoming reversal stick. They work well. If you look back here, and I point out at the time, all the way back in when the stock market peaked, the very last day, the very all-time high in the NASDAQ 100, which peaked before the S&P, was right there, and it was with a bearish engulfing candle. It engulfed the previous two candles. It was confirmed with a red stick. You never even got anywhere close to above it. Later on you came back, but the high of that candle was the end, officially the end of one of the greatest bull markets in history, and officially the start of the bear market that we're currently in. So I'm just saying these things often work, but not always. And most importantly, like I said, when I can sit here like I'm doing now and say, hey, market can go up, market can go down, I give if you can make it almost an equal case, coin toss odds, then you need to flip, you have to flip it one way or another. You can certainly get out. There's nothing wrong if you don't know what the market's going to do. I always say get out. But if you're already short, then you give it to the benefit of the doubt to the prevailing trend, which is bearish. And that's what I do. So my swing trend positions, I'll remain short unless I start to see additional bullish evidence. The first and foremost would be a daily close above that bullish engulfing, and of course above that high that we had the other day. So up here you have a downtrend line. So really a daily close up there, and even more so a weekly close. And pretty much the way it works, I've said this last week, it's not a all or none situation. In other words, if you go up there, it's not, okay, close all shorts, go fully long. No, it's an incremental thing for me, that the evidence starts to mount that maybe a tradable bottom is in, but then I scale out of shorts, and at some point I decide if and when to scale back into longs. Or if I scale out of my shorts and then it proves to be a whipsaw, where do I get back in? So, I'm going to be very flexible with this stuff. And as of now, let's not overthink things. This was a big level there last week. It has been. I'm sorry. It was a big level back here. And again, that was T3 on the weekly chart. So we hit it. We bounced as expected. We gained that bounce. This is where I mentioned scaling out of the longs and back into shorts right there. All through that. 200 days were always the target, the max bounce targets, 200-day simple and exponential moving average, as well as a downtrend line. And then this is so far has been the next leg down. Like I said, the fact we hit it already and we had a reaction, I still favor the downside. I just can't say the odds are super strong, but what happens, just like incrementally, the case can start to go up. The odds can start to increase for the case for a rally incrementally to the upside from here with every tick higher, especially every tick above, the recent highs. Likewise, as we go down, especially we start to take out, get down towards those lows, another rejection here would be pretty bearish. Remember, it's earnings week. Things are going to be choppy. Companies reporting. We're getting really about heading into the thick earnings season. Then you get the big techs coming up, the big fangs, in another couple weeks here as well. And that's really the hump day, if you will, or hump week coming up on earnings week. All right, so that's it. Can say the same thing over and over. We're back testing resistance. That's an objective shorting op, and based on the kind of the almost bilateral risk reward, to the upside or downside, I would say just don't go super heavy would be my recommendation if I can give one. Not really in the business of giving recommendations. I'm in the business of posting my analysis, my thoughts. You guys do with it what you want. All right, so that's it. Let's not really go over much more. We can sit here all day long and hash through it. Let's just see how we close. Oh, let me show you for your futures traders. Yep, I should do an update on NQ. It's almost the same chart, but you have the after hours trades, around the clock trades, I should say, the Globex. There's a larger trend line. It goes to the left of the chart up here, but that's a primary trend line. I have the secondary downtrend line right here. We have some, nice clean major reaction high there, right there. A couple bounces off it, got rejected last week, and so that's big right here. So I think if we can pop that, then you can see my resistance level is about 11,350, 11,541 or so, and then a big level here about 11,748. So break above there, let's just say it could stop at any one of those resistance levels, but I think we'd probably run up there, whether we back test first or not. At this point in time, I'm going to start an uptrend line right here. Looks like we'll have the early makings of one. We'll have to see how that develops. And of course, resistance is resistance until unless broken. So you're at right now price resistance here. See these reactions there? That's about 11,100, and the downtrend line just a hair above it. So that's certainly an objective level to short. My guess is it's earnings week. Probably not going to see any big fireworks today. So if you got a little pullback trade, things have been choppy lately, guys. That's it. So you have to recognize what you're in. We're not in a very, at this point in time, a strong trending market. But when you do step back, remember what the primary trend is right now. And although we have all these divergences and the potential that the Fed may pivot, everybody's been holding their breath for it. This is the reality. If you step back, this is mid-August right here, you can see we are stair-stepping lower. And nothing changes that. When does that start to change? Well, you take out this downtrend line. You're also going to take out that previous reaction high. Then you have another previous reaction high there. Each of those, if and when those happen, you take those out. Those are check marks for the bullish case, because now you've started to get the early makings of a near-term uptrend. Remember, a near-term uptrend is simply defined as a security making a series of higher lows like that and higher highs, and so you have to take out those previous highs. Right now we don't have that. All we have is a rally back into resistance. So again, it is an objective shorting opportunity, an add-on, a new short entry, and depending on where you think things are going, you either keep stops real tight or you can have a much more liberal, looser stop, maybe above that downtrend line, something like that, and that big level right there about 11,785. All right, let's move on to Treasury bonds, and I'll get the video out to you guys. All right, let's see. The big one, the 30-year bond. I'm looking really focused on yields because this is clean. TLT is the 30-year bond. This is TYX, the 30-year yield. Remember, this is an inverse to the TLT. Bond prices and yields move opposite. And this is a very clean, very well-defined uptrend line. What do I mean by that? Well, look, clean because you don't have any violations. Well-defined because you have numerous reactions, tags of the candlestick, either the shadows or the bodies along that trend line. And so that is, and I believe I have, and I'll set it if not, price alert on there. When that one triggers, that should bring us down to the next more significant uptrend line that comes off the December lows right there. And then if and when that goes, which I suspect it would, this is the first target here. Let me turn on those levels. I don't know why that's not on, but again, that's the yield. You don't trade the yield, you trade the bond. I don't know if there's futures on the yields or not. I trade CB, ZN, ZF. I have all three right now. Those are the futures that are the same as ETFs I gave you this morning. So that one we'll watch, and then, but you want to see all these yields break down. The more the better. It's kind of like the way I trade. I like to see if I have a trend line or a support level on QQQ or the NASDAQ 100, and I have a comparable uptrend line on, let's say, the S&P 500. I want to see them both break, because if QQQ breaks the trend line and SPY shortly after falls down and hits its comparable trend line, but then the SPY traders step in and buy, market bounces, then guess what? It causes that QQQ breakdown to be a whipsaw because the buyers will step in. Maybe there are more buyers stepping in and buying. Yeah. So where I'm going with that, same thing with these yields here. The 10-year is much closer to cracking. If you trade bonds, hopefully you know all this, but the longer the term of the bond, longer the maturity, the higher the duration is. Duration is what that means is not it's not the maturity, it's the expected move in the bond prices for every 1% move in interest rates. In other words, longer term bonds are more sensitive to changes in interest rates, so you tend to get more bang for your buck, bigger moves in the long bond than in the shorter term. So the 30-year is going to move up and down more. It's more volatile than the 10-year, which is more volatile than, of course, the 5-year. So this is it, TNX, I'm sorry, the 10-year yield. This is where I believe it's going. I am as confident as I've been about on anything that sooner than later, whether it's announced outright or it's behind the scenes, both the Fed, the Treasury, and other global central banks around the world, there's going to be an intervention, because this rise in rates is it's unprecedented and it's unsustainable. It's been a parabolic move up in interest rates, near parabolic, and it's gone parabolic actually, because you had an uptrend line, then you get these steepening uptrend lines, and that's the whole making of a parabolic move. And like I said, and I've been saying this for the last couple, at least several weeks, not a month or so. Now I'm seeing it in all the papers, financial media. I'm reading different sources talking about something's going to break. There's articles saying, well, experts aren't citing exactly what, because it can be anything. But I promise you, if the rates keep climbing at the rate of ascent they have, because there's been nowhere to hide, nothing's making money on the long side. And hedge funds, they don't typically short. I'm sorry, hedge funds do, not pension funds and all that. And you know what's going on in the UK, and they've been reading articles now. There was a good one out there the other day. Was it Barron's? Maybe the Journal, and they talked about KFC, for example. Now this is not a huge company. Yum Brands is the actual name of the company, YUM. The KFC has four of their executives, the COO, all these high ups are all retiring early, because there's going to be a huge adjustment to the pension plans. Most companies in recent years have gotten away from pension plans where you retire and you get a check every month, taken care for the rest of your life. They've moved over to, those are called defined benefit plans. They've moved over to defined contribution plans, which are 401ks, where you put money in, you define how much you want to contribute, and then you're on your own for making that grow and then drawing off it when you retire. However, there are still a lot of legacy pension plans out there, and the costs are ginormous to these companies. And now, so these, it's causing this cascading effect, and that's the gist of this article, that had these executives stayed on until the next adjustment due to this big, huge rise in interest rates, their pension, their lump sum benefits would be huge. I think it was something to the tune of like don't quote me to this number. I think one person they cited in an article was looking at, like, let's say $1 million lump sum benefit. Instead of taking the pension for life, you can take lump sum benefit, just like when you win the lottery. You can take it over 30 years. You could take the lump sum at a discounted rate. So anyways, this person was looking at, let's say it was $1 million, but if they wait until after January 1st, it's going to be like 600,000, 700,000, a huge adjustment due to the higher rates. And so what they're saying is it can be almost similar, like we had the bank run back in the Great Depression, 29, when the stock market crashed, where if you've got a lot of these companies, and a lot of those, General Motors, Ford, a lot of they still have their legacy pension plans. And you're going to have a lot of people pulling out the early retirement, knowing that their benefits are going to drop. And then what that does is it's a domino effect. Pension plan has to pay out a big lump sum payment to these big executives. They have to liquidate assets right now at a time where they're already stretched. They're already down big, and they have to sell low. And that selling then begets more selling. You can't just write a check on money you don't have. You have to then liquidate something. If the pension fund doesn't have cash on hand to meet all those redemptions, they have to then sell stocks, bonds, whatever they have, and to meet it. So anyway, that's one of many things. And again, the global financial system is so intricate with so many nuances and moving parts, but yet they're interconnected. So when one thing breaks somewhere, you throw a little wrench in the cogs and the gears get all gummed up, and then at that point it will be a domino effect. So far the market's relatively shrugged off what's going on in the UK with their pension plans, their insane turnaround with the tax cuts. They're all over the place, and that's, again, these are cracks. These are very, very visible cracks forming. And so where I'm going with all this is the global central banks, the Fed's already lost credibility. And the last thing Powell wants to do, especially after coming out so strong just a couple months ago, months or so ago, starting at the Jackson Hole meeting, we're going to keep raising rates. We're not even thinking about stopping. He was jawbone in the markets, but trust me, they will pivot. This is unsustainable. And the takeaway, to me, it's one of the most attractive risk-reward ratios. The setup is beautiful in itself. But again, if you look at how much treasuries have gone up, you can go to the long term, the monthly charts. You talk overbought for treasury yields, it would be an understatement. And you have big resistance coming up here. Here's TNX. It has broken out the long-term downtrend line, so we are now in a new bull market. This is early stage bull market action for interest rates, but yet there's very significant resistance that the 10 years run into. Big resistance right there. I had a line at let me show you the yield, about 4.5% right there. And so what I think will happen is we're going to back test. This is just too much, too fast. It's a breakout, a lot of momentum, probably come in and back test. And so that will be a nice trade. That's bullish for bonds when that happens. That's TNX. TYX, the 30-year, same thing. Look at this, almost a 4% yield on the Treasury, the 30-year. Big resistance right there. That was that major reaction high back there. We had quite a few reactions. It was support for years till the financial crisis. That was a major support level. Then the financial crisis hit back in '08. They started, boom, that was the first round of quantitative easing, and then they just kept printing money and throwing every time the market threw a little hissy fit, print more money, buy more bonds. And that's what you can see here. So they took rates artificially low, well below where they should have, and now we're paying the price there. So, but again, that's what's already happened. That was forecasted. It was in the charts and everything. And so if we get a nice pullback, and like I said, you can trade the futures like I do, or the ETFs. You just need to put more in ETFs because they're not leveraged. If you go like this is TLT. I like to use the yields, just a better chart. Remember, ETF is going to do a decent but not perfect job of tracking. There it is. You can see it's at support as well. I just had to tweak that trend line a little bit. Oh, and so what are we talking here? There's the falling wedge. There's that trend line forever and a day. I said we need to break out of this price channel. And so when we do that, when we break out, we're looking at minimum up there at about 108, and that would be from where we're at now on this daily chart. That's about a 9% rally. And that's a big move. Again, you might say, 9%, I can get more than that on Apple or Microsoft or Bitcoin. Yeah, but you can't put as much. It's beta adjusted. You can use, like I said today, 2 to 4 times what you would normally put in the S&P 500 and Nasdaq 100 because of volatility. And a big day, TLT goes up or down 1%, maybe a little bit more than that. On a normal day lately, the S&P 500 or the Nasdaq 100 is going up and down 3%. You know, in some days we've had these five, even recently a 6% intraday swing. So therefore, you put less money, relatively speaking, into QQQ or NQ than you do these guys. So if you leverage up, or just stack your position size, a 9% return. If you have twice what you have in the S&P 500 or Nasdaq 100, you're talking then about an 18%, or the same. You'd make the same dollar amount you would on an 18% return for a position in QQQ because you have half the capital put into that. So that's it. Like I said, I'm spreading over me personally. I told you I had ZB and ZN I've been scaling into. Still waiting for those buy signals to go my all-in moment. And then where's ZF? ZF, this will respond, well, they'll all respond, but this one, if there's any kind of pivot on rates, any utterance, and we're already starting to hear the rumblings. It always starts from the other Fed members come out and they do their little dog and pony shows. They're going around and giving speeches in between the big FOMC meetings. And there's already talk that some are concerned of, are they doing too much too fast? Should they wait and see? So this is ZF right here if you're trading that, the 5-year. Pop that, you have some little resistance there on 107.060, then a nice clean downtrend. Look at that. You pop that trend line. I could add a line there, and you should. I probably should have a target there because that's a reaction high. But I think there'd be a pretty big short squeeze, short cover and rally, run up here, minimum 109, 119, and quite likely up there 111, 152. And if so, that would be on the 5-year 4.41%, 4.5%, we'll call it. And ZF, yeah. So that one's they're inherently leveraged. Again, if you don't know what I'm talking about, if you don't understand the multiplier, which is a leverage factor in futures, you don't understand how futures trade. Read up on it, learn. If not, stick with ETFs or just pass if it's not your cup of tea. I'm going to put another line right here. I see some resistance right there. Okay, that's it. I'm not seeing anything that I don't know. Maybe it's just me right now wanting to kind of lighten up on other things. Crude, nat gas, just kind of watching there. These are the main things I'm watching right now. But keep in mind, it's earnings season, so you're in a bear market. You have a lot of big companies reporting this week, especially a lot of big financials still coming out this week. And so you have to expect volatility. And so if you're not a patient trader, if you're the type, and I get the little posts in the comment section, you get frustrated on these intraday swings, the reversals, whipsaws, then don't trade or take your position sides because this is when you're going to get it during earnings season. This market's going to pick its next direction very soon. That I have a pretty good degree of confidence on. No later than within the next 2 weeks or so, because that's once Apple, Microsoft, Amazon, Facebook, all those guys report they're out of the way. At that point, this market's going to know whether it wants to rally and maybe run up to those 200-day moving averages and the downtrend lines like I showed you earlier, or if it doesn't like what it hears and wants to take that next leg down. Like I said, now despite the we've had a couple nice rallies today included, we're up about 3% or so. Was that I think 3% in the Qs right now? There's still bear market rallies, as I told you. These biggest daily gains, they always come in bear markets. They don't come in bull markets. Not in the middle of a bull trend. No, not So this is par for the course in a bear market. Volatility increases. We're at resistance, and look, boom. If you can pop it, great. If not, and also remember this. By the way, I talked about the incrementally, increasing the bullish case or increasing the bearish case. But remember, and I'll leave it with this. during earnings season, especially peak earnings week, in the next couple weeks, the odds or the chances of whipsaws is infinitely higher. This is the norm because you have one big company after another reporting, giving guidance, and so again, if you're risk averse is almost it's an oxymoron. If you're trading, then you're obviously not a risk adverse person. But when I say relatively risk averse is what I'm referring to, a relatively risk averse trader or investor, it's a good time to either stand aside or keep things very light. And there's nothing wrong if you think, like I do, that this market's going a lot lower. Just have your stops in place, wherever that is for you. I don't know if you shorted here. These are original short entries here and here. And then every back test here we've had. Again, it kind of blurs the line between investing, swing trading, active swing trading, and day trading. I do all of the above. And so, over the last year, I've posted dozens, if easily high dozens of objective short entries and objective long entries. And so, swing trading a bear market down, like I've talked about, to me has been extremely profitable. My account's up a magnitude order higher than the stock market is down. But again, I don't just trade the stock market. I've been long crude, lumber, and natural gas, or short those things, and Bitcoin, all in between, and then gaming this as well. And so that's the gist of what this site is about. That's I'll sometimes give you some short-term setups, but this is swing trading is what we're all about. We're trying to game these rips and dips. I'm still leaning towards this. That I am. But like I said, you can hear it in my voice, and I make it very clear that at times my confidence isn't as high because I wouldn't be doing my job if I wasn't pointing out the potential bullish developments. I covered market breadth improvements on some indicators last week, some sentiment indicators getting up there, but then by every metric that I've ever used, a bottom has not been put in this market. This is not, even if we have that bullish engulfing candle that materializes, it would not at all, to me, be indicative of the end of a bear market. In other words, it would not, in my opinion, point to the market going to new highs and beyond, entering a new bull market that takes out the previous highs. At best, it would be a bear market rally. And this also talks of bull market, bear market semantics. Again, I'm going to try to game a 15-20% rally as I game these other rallies. And you call it a bull bear, call it a correction, call it a counter trend bounce, call it what you want. I just, like I said, I don't. Bear markets are just too lucrative to just short and sit and tuck away unless you're really adverse or you don't have the time or inclination to actively trade them. But to stay short and then to try to not ride out, step aside, either cover the shorts and or go long and catch, some of these rallies. And so right now, like I said, I'm ready to pivot, but not yet because we're still back testing resistance right now. We were rejected there last week, and so far today, well, we're there right now. So we haven't been rejected. We're testing that level once again. There it is. There's the top of the bullish engulfing candle. And if we go a little higher, that's fine because then we have a trend line, downtrend line to test, and as well as that reaction high from Friday as well. So, all right, let me get it out to you guys, and I'll look for some other trade ideas. I'll go over commodities and see if there's anything else that stands out right now, and then I'll get that out to you in either some screenshots, individual charts, or maybe another video. This has been Randy Finney with Right Side of the Chart. Have a great day.